Okay, now we need to do diluted earnings per share. And it's a complex capital structure, so of course it's going to be more complex than the basic earnings per share. Okay, so this is required for companies with a complex capital structure. And it's basically hypothetical. I don't think that's spelled right, but anyway, hypothetical because it is assumed that everything that can convert to common stock does convert. And then net income, preferred stock dividends, and common stock outstanding are adjusted as required. All right, a diluted earnings per share will always be less than basic. Okay, so you start off with basic earnings per share. All right, and then you do a tentative diluted earnings per share, and they call it tentative because some conversions may actually be anti-dilutive, and if they're anti-dilutive, you don't include them. For instance, if the market price per share is less than the exercise price of a stock option, then you wouldn't exercise the stock option because you could just go out and buy it for cheaper as opposed to exercising the stock option and having to pay the exercise price. Okay. So you do the tentative diluted earnings per share, and then you rank them from the most dilutive to the least dilutive effect on earnings per share. And then you add them in to get diluted earnings per share. And the one you keep is the lowest diluted earnings per share. It's terrible. But anyway. So here's a lovely flow chart. Not sure if that's going to help you. But anyway. So look at this capital structure. Here, let me copy this over here. Maybe I can Okay, so you will only assume conversion of, let me make this big for the moment since I have this here, of items that are dilutive. If not dilutive, it's called anti-dilutive. You don't include, or you don't assume that they're converted. All right, so this is what they're talking about here. You compute the basic earnings per share and tentative diluted earnings per share. All right, so if you have share options and warrants outstanding, is the average market price greater than the option price? Yes. All right. If no, then you don't worry about it. But if yes, then you convert it and you do what we call apply the Treasury stock method that we'll talk about into your dilutive earnings per share. Okay. If not, then you see, do you have convertible securities outstanding? If yes, then you rank the convertible securities. Those are like convertible preferred stock or convertible bonds. You look to see if they're individually dilutive, yes or no, and then you go on from there. Okay, so that's what this is talking about. Guess I didn't need that whole giant thing, but anyway. I can make it smaller. Okay, let's go back. All right. So now we need to talk about all the things that have to be changed or considered when you're converting. All right, share options and warrants. Remember, this gives you the right to buy a share of stock for a certain price, for the exercise price. All right, in this case, we're going to use what's called the Treasury stock method. All right, so what that means is you assume options are exercised. You use the cash received to buy back Treasury stock. Remember, all of this is just on paper. It's not actually happening. All right, the shares bought minus, well, let's see. I'm going to say shares exercised minus the shares bought back equals the net increase in outstanding stock. Okay, so let's see if they gave us some numbers to deal with. All right, so we use the average market price. Use average market price of common stock to calculate shares repurchased. Once again, remember, all this is just on paper. You're not really going back out and buying stock. Okay, so here are their numbers. Plumber Company Corporation, whatever. Plumber Corporation has compensatory share options for employees to purchase 1,000 common shares at an exercise price of $18 per share throughout the year. And the average market price for the common stock during the year was $25 per share. The unrecognized compensation cost related to share options is $2 per share. The net increase in the denominator is 200 shares, which has a dilutive effect on earnings per share. Okay, well, let me see. So you do dollars received from stock option exercise, and it's going to be the 1,000 shares times, and notice here you do the $18 exercise price plus the $2 unrecognized compensation cost. All right, so my dollars received going to be 1,000 times 20. All right, so I'm going to get $20,000. All right, I divide that by the average market, which is $25. And then this is the number of shares I can buy back. This is shares. Shares repurchased. All right. So shares exercised was 1,000 less shares repurchased. So this is an increase. It's like a net increase. And since it's a net increase, then it's dilutive. These are all shares. Okay, for convertible securities, you use the if converted method. Okay, so for convertible preferred stock, that means that no preferred stock dividends anymore, and common stock will increase when it's converted. For convertible bonds, you have to adjust net income by the interest expense, and actually it's net interest expense. Let's see what they have here. Yep, net interest expense, because it's net of income tax. By the net interest expense. All right, you're going to add that back. And common stock outstanding will go up. All right, so to figure out the impact on diluted earnings per share, you figure out each individual increment here. So the increase in earnings per share numerator, so without the preferred stock dividends, or the preferred stock dividends divided by the increase in common stock, and that's how you figure out the impact. Okay. The one that has the greatest decrease in diluted earnings per share is the most dilutive, and then it's added in first. Okay, oh my Lanta. Here's the examples. All right, so here's the summary of convertible securities for this company. They have 9% convertible preferred stock. Dividends of $5,400 were declared during the year. The preferred shares are convertible into 3,000 shares of common stock. All right, so let's just go here. They've got it all worked out. So A, you've got the 9%. This is an example of ranking. All right, so for A, your effect is going to be, you're going to add back the $5,400 of dividends declared divided by the 3,000 shares. And it's going to have an impact of $1.80. Okay. All right, B. $100%, 10% convertible bonds. Interest expense, net of income taxes of $4,800 was recorded during the year. The bonds are convertible into 1,920 shares. So that's $250. C. $8 convertible preferred stock. So dividends were $8,000. They're convertible to 5,000 shares. So $1.60. And D. 7% convertible bonds. Interest expense net was $6,300 divided by 3,150 shares. All right, so this is dollars. And this is shares. Okay, so the order and ranking, this one with the lower impact, this is the most dilutive. This is the most, then the $1.80, then the $2, and then the $2.50. Right, this is the most dilutive. And this is the least. I don't like how the most complex thing in this chapter is hypothetical. All right, so calculation of the basic and earnings per share. Let's go to the numbers. All right, Davis Corporation reports, oh, this is special issues. I want just a regular one. Not that worried about special issues. Okay. This is a normal one. So we're going to do Randolph Corp. All right, Randolph Corp had net income of $2,800, income taxes 30%. They had 900 shares of common stock outstanding the entire year. Options were outstanding the entire year. The assumed exercise price of these options will result in an increment of 85 shares of common stock. So they already calculated that for us. That's nice. 100 shares of 8%, $100 par convertible preferred stock were outstanding the entire year. 800 in dividends were declared on this stock. Each share of preferred stock is convertible to 4 shares of common stock. We had convertible bonds, $5,000 face value. Bonds have a stated interest rate of 6% interest, but were issued at a discount. Bond interest expense of $320 was recorded in 2019. Total discount is being amortized at the rate of $20 per year. Each $1,000 bond is converted into 32 shares of common stock. And, oh, they actually did the ranking for us. Okay, so on this one right here, we've got 5 bonds, and they're issued, there's 32 shares, so you do 5 times 32 to figure the number of shares. so ranking of convertible securities. The convertible preferred stock, they had a dividend of 800, and they told us that each share is converted into 4 shares. And there was 100 shares outstanding. So this is going to be 104. Oops. So $2 there. And then the bonds. Convertible bonds. All right, the change in my numerator is going to be the 5,000 face value times the stated interest rate. All right, plus the extra $20. That's how they got the $320 because they amortized. All right, and it needs to be net of interest. So you're going to multiply it by 1 minus the interest rate. And then that is over the 5 bonds times 32 shares per bond. Okay, so that equals 5,000 times 0.06 plus 20 times 0.97. Or no, it doesn't equal that. Why did I type it wrong? Dude. Doesn't 5,000 times 0.06 is 300 plus 20 is 320. Well, I seem to get a different number than they do. I agree with the setup, but not that number. Still goes first. All right, so this would be 1, and this would be 2. All right, so now I'm doing the earnings per share. So basic EPS is going to equal the net income of 2,000 it's actually 2,800. The net income of 2,800 minus the 800 of preferred stock dividends. All right, divided by 900 shares outstanding, because that's what's outstanding, right? I gotta go back up here. 900 shares were outstanding the entire year. Yep. then for diluted earnings per share, it's kind of funky how they do it. They're going to do the bond stuff first. Okay, so it's going to be the 2,800 minus the 800. All right, plus, in my case, it's 310.40, so we're going to get a different answer. They're using this 220, but that is not what I get when I multiply that stuff out. Let me double check it one more time. I know 5,000 times 0.6 is 300. 0.06, right? Plus 20. And then times 0.97. I still get through. Okay. So that's my net interest. I'm going to add that back. And then I'm going to divide by 900 plus the 160. Oh, I forgot about the options. 900 plus the 85 that they did earlier. I don't think I did them. I'll go back and do it in a minute. All right, and then plus the 160. All right, $2 per share, which is lower, so we're still okay. And then we do it again with the preferred stock coming out. So now I'm not going to subtract my dividends anymore. So it's going to be 2,800 plus the 310. Divided by 900 plus 85 plus 160 plus 400. And it's still even a little bit lower. See how it went down even a little more? All right, and my number is different than theirs because of those shares. What does it say? The $2 impact on diluted earnings per share of the convertible preferred stock is more than $1.94. Therefore, inclusion of preferred stock in diluted per earnings would be anti-dilutive. No. They left theirs like that. They didn't add the $2 in. But my number is different than their number, so... Okay, but you get the basic idea. Okay, back up to this 85. Did they just tell us that? Did they? Oh, they did. They told us the 85. They didn't actually calculate it. All right, so that's going to be it for me. And then we'll do some exercises that show you how to do this.